Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. And we're talking about the three categories of retirement income before the break, and I want to pick up on that again. When we're talking about the difference between taxable, this, by the way, is when I talk about asset location. This is what we're talking about. Having the more locations, if you will, that you have. And we talk about asset allocation all the time, how much you're going to have in stocks and bonds as an example. And when you're talking to your investment advisors, they're telling you those same things, right? They're going to, the more bonds you have, the less. In fact, they'll typically, there are funds out there even that target funds that basically, and asset allocation funds that over your lifetime will start to reduce down the amount of stocks and put more and more into bonds. So these target funds, as an example, that's what they do automatically. And because the consensus, basically, general consensus being that as you near retirement, reducing your risk, meaning reducing the amount of stocks in your portfolio and putting more bonds in, is a way to do that. Now, as I mentioned, in this environment, the bond market is down this year. When we look at the AGG, we're looking at the index, which is a bond index. Basically, we're seeing that down about 6%, I think, still year to date. When you get into that kind of environment, now all of a sudden, well, our bonds really as safe as what we thought. And that's where we, again, the piece I mentioned about from Roger Ibbotson about plugging in fixed index annuities could be a big plus for you there. So you want to have your monies divided out then, not only about managing risk and about improving returns, but of course minimizing taxes. And the more of these categories you have, the easier it is to develop more tax efficient strategies. In other words, to minimize taxes throughout your lifetime. And why do they matter? Well, the answer is the heart, which is, again, how the taxes, how they're taxed helps us. So sometimes if you've got the right resources, and this is what this is about, it's helping you develop them. If you're already in retirement, how to apply these strategies, it's how you can use those to where, let's say you had $120,000 that you need for income to live on every year, and your that would put you in currently in a 22% tax bracket, so some of that would be taxed at 22. Well, we want to try to keep you in a situation like that. Are there ways that we can keep you in a 12% tax bracket? In other words, save you, I mean, kind of cut the tax dramatically on that approximately $15,000 that's over into that 22% bracket. So how do we do that? Well, if you've got these, we can take some of the taxable dollars as an example and use that for income, and take fewer dollars from the tax deferred, which is going to be taxable to you, and in some instances maybe even use tax-free dollars to keep you in a lower bracket. Now, the other thing that comes into play there is that of, we're going to get into strategies like Roth conversions, because we're going to talk about required minimum distributions. There's a pending, with the Secure Act that passed in 2019. We want you to, I've talked to you about that many times on the show. Well, now we have legislation, pending legislation that passed the House. This is referred to as Secure Act 2.0, and basically they're going to make some additional changes as far as retirement accounts and understanding how these work and how that's going to impact you, in particular with required minimum distributions. That's going to be something very important for you to understand. So let's look at the next slide, taxable sources of income. This is understanding then with those type of incomes from investment sales, earnings, stocks, most bonds, etc. The type of tax paid on that would be capital gains, or in some instances with the interest, it could also be ordinary income taxes paid. Social Security, ordinary income tax paid on the taxable portion. Now, with Social Security, it depends on how much income. Up to 85% of your Social Security benefits can be taxable, considered taxable, and if they are, if that applies to you, of course, they are taxed at ordinary income tax rates. And then profit from selling real estate, again, capital gains if it's held over a year, and that's a very important part to understand. The next slide goes into capital gains tax and then how that one works. Now, we're talking about, again, the difference between short-term capital gains, which basically are ordinary income tax rates. So if you hold it for less than a year, whether that's a property or an investment, a stock or whatever, then that's going to be taxed at, again, at ordinary income tax rates, which are, of course, higher than capital gains rates. Long-term gains are earned on investments that are held for more than a year. And there's according to how much you make. So if you look at the chart here at the bottom, you see that the long-term capital gains rate, if you're in a 12% bracket, okay, 10 or 12%, including the gain, then you pay zero tax on those capital gains. And we use that strategy when we're talking about income as well. This might, by using capital gains in particular, if we're in a 12% bracket and using those gains as a means to, again, give you more income, but at the tax advantages of capital gains with zero tax on those gains at the same time. So it's a great strategy to employ. How the gain is taxed, again, depends on how long. So you got to hold it for a year. And again, this is, by the way, for 2022. These are the numbers. And you can see once you cross into that 22% bracket, right, and above, now you're looking at a 15% capital gains tax. And if you get into the upper bracket, the top bracket, it goes up to 20% tax rate. Sometimes when people sell a farm or some large piece of property where they have a huge gain, maybe $1 million or more, this is the kind of thing they run into. And we get into then some different strategies that we can employ to help you. So if you've got a long-term capital gain coming up that's going to push you up into that top bracket, and keep in mind at $250,000, you're also going to trigger an investment tax. It's a surtax, if you will, Medicare surtax, I believe they refer to. But basically, once you cross over 250, now you're looking at another 3.8%. So that 15% becomes 18.8, 20% becomes 23.8. You're talking almost a fourth of your money gone, your gains gone in taxes. However, there are some strategies. If it's real estate, things like a 1031 exchange can help you defer tax. An installment sale. We have what's called a tax deferred savings trust. So these are ways that you can refer, or basically, let me just put it this way. There are strategies that we can employ if you have large capital gains to help you to reduce the tax on those gains, okay? And we just have to match up the right strategy with your individual situation. Again, if you need help with that, call my office at 615-376-5325. All right, now let's take a look at the tax-deferred source of retirement income. So these are things like a pension, all right? Ordinary income tax is what you're going to pay for pension income. In other words, are taxed at ordinary income tax rates. And tax-deferred retirement income includes savings plans workers have available through employment. Again, IRAs, 401ks, SEP IRAs, 457s, again, TSP, thrift savings plan. So taxation's postponed or deferred. I mean, right? You put the money in, you don't have to pay tax on it. When you take the money out, you're taxed at ordinary income tax rates. Annuities, this is another type of a retirement account. We've talked a lot about annuities. Fixed index annuities is one of those that is a great tool for you in retirement, or can be. But again, when money comes out of the annuity, it's taxed at ordinary income tax rates. Now, I'm going to clarify that a little bit. When we're talking about annuities that are used, let's say, with IRAs or retirement plans, sometimes annuity is a type of retirement plan, but you can put money in that you've already paid tax on. So as an example, if you put $250,000 into an annuity and you've already paid tax on it, this is savings money that you've saved up over time, and you put that $250,000 in there, that money you've already paid tax on. So when you start taking money out of the annuity, that's not going to be taxed. Only the earnings on it, only the interest that it earns is going to be taxable to you. And that, again, is another way, another strategy we can use to get you higher income while managing your taxes at the same time. And then let's look at the third source, and this is tax-free sources of retirement income. Now we're talking about certain municipal bonds where capital gains, if any, apply. With munis, a lot of times people invest in them because in many instances that's tax-free income. The downside of munis, of course, they don't pay a lot, right? So in particular in this environment, they pay very, very little. So sometimes even depending and here's something else with municipal bonds I think needs to be understood. Municipal bonds, when they're issued by these government entities, right, they know the market. They know how much, based on their credit rating as an entity and what they're issuing, what they need to, or ask for as far as return. They're looking to basically raise money for some project or for whatever purpose. So they give you the municipal bond. This is you're investing or loaning this government entity money, right? You're getting a certain amount of interest. And depending on the risk associated with that government entity is what that interest may be. The more risk, of course, the higher the interest. But even with that, you're not getting a lot of interest. And they're looking at it, recognizing that it's tax-free to you. So they're offsetting what a comparable taxable bond investment might be. So basically what I'm saying to you is that unless you're in the upper brackets, munis typically are not the best way to go. Maybe if you're wanting a fixed type investment, this is where you might look at corporates and compare, in particular, the after-tax result of that. Okay. Retirement savings, Roth 401k, Roth 457, Roth IRAs. Again, we talked about the traditional one. Well, they also have Roth versions. Again, depending on your tax bracket is which way you might invest is one consideration. Another consideration, I know currently, if you want to put money into a Roth 401k or TSP as an example, they don't match that money. So you want to get your match. So you want to first put, let's say you get a 5% match. You want to put your 5%, the first 5% in your traditional account, your traditional 401k, your traditional TSP, so you get the matching. Then, you know, depending on your tax bracket and other considerations, you may want to put some money into the Roth as well. And that's how you would use that strategy. Again, if you need, I'm sharing with you how these can work, but if you need some help with that, call my office for that. If you, maybe you just have some questions, you can call and set a phone appointment with me as well. Health reimbursement arrangements, health savings accounts. On the health savings account in particular, if you put the money in, you get a tax break. You don't have to pay tax on the contributions. I think it's about $37.50 for an individual and about double that, around $7,500, give or take. Again, we'd have to look at the chart, but about $7,500, I think, for a couple. So when you put the money in, again, just like putting money into a retirement account, you don't have to pay tax on the money that you contribute. And if you use it for qualified medical expenses when you take it out, then it's tax-free to you. You don't have to pay tax on it. Non-taxable portion of your Social Security income, life insurance cash value we mentioned. And by the way, with Roth, to go back to that one, this is one can be a tremendous resource when we talk about doing Roth conversions and that strategy and how it can be employed to help you reduce taxes during your lifetime, or over your lifetime, I should say. But initially, you're going to be paying tax, of course, on that up front. This is a really great strategy and can be very helpful. And keeping in mind, there's some rules coming. I mentioned to you about Secure Act 2.0. Some of the things they're talking about is raising the RMD age when you have take it, which they just raised with the Secure Act in 2019. It went from age 70.5 to 72. Now with the new Secure Act 2.0, assuming that, and it could very well, it's already passed the House, so, and it's got bipartisan support, so very likely to become law possibly this year. And the effects that would have is starting to raise the RMD age over your lifetime to where it'll go up to age 78. Now that's over, I think it's phased in over about 10 or 11 years, so it's not immediate. I think the first year it might bump it to 73. So if you're already taking RMDs, this law is probably not going to really impact you. If you're not taking RMDs, of course, then yes, it could extend out the period by which you will have to start taking those. When we get into Roth conversion stuff is when we start thinking of what your income going to be in the future when you start taking those RMDs. Is it going to push you into higher tax brackets? And if so, we might want to employ some Roth strategies to help keep you out of those higher brackets later. So a lot to, now, we can go ahead and get rid of the slide for a moment. One of the things that I want you to think about when you're, when it comes to this kind of planning, one, it gets pretty complex, just like sometimes with annuities. Annuities can be complex, but that's because they're building flexibility in, which is to your benefit. All right, so it's not necessarily a bad thing. All right, but by the same token, understanding how these rules work, like with Roth, I put that money in, I've already paid tax on it, it gets to grow on it, so I'm not getting a tax break today. Right? But it grows tax-free, and when I take it out, it's tax-free. So there's some tremendous advantages that can be had with that. In particular, if you, like I, believe with all this debt and the way we're spending money like crazy, that we're probably going to end up with higher taxes in the future. Right? Would you agree? And if you think taxes are going to go up, then this Roth strategy could be an excellent tool for you as well. All right, we're going to take another break. When we come back, I'm going to delve in a little bit more on this on Social Security and how it's taxed, and again, how we can also help you minimize taxes there as well. First to break, join us here. We will be right back on the Retirement Report.